Hello, all. This is Khyla P. Barnes, your financial chef and coach, and I am back with another short episode that's going to be a little different than the previous podcast because I am a very versatile girl. This is going to cover some very granular details about finance. So, if you do have a pen and paper, this is probably the time to go get it if you don't have one already. What I'd like to cover today is going to be the business cycle. This can get complicated really quickly, but it's really good information. I'll also try to post some slides or pictures that you'll be able to see there during this video that will highlight it a little bit more. So, just a introspection. I guess one could wonder why we are covering the business cycle. Well, we're covering the business cycle because it drives the economy. It also reflects what is happening if we were to look at the economy from a framework. The business cycle is like a clock, which I'll be able to show you. The clock, as you know, time never stops. 12, 3, 6, 9. It always keeps going. The same thing is with the business cycle, except it looks like a hill. But the hill keeps going. It keeps going. The business cycle has four intervals. That's a good word, intervals. The very first is called the early. That's the first interval. The second interval is called mid. The third interval is called late. And the fourth interval is called recession. I think we're all familiar with recession because it's the R word. Ooh, it's so drastic. But the recession is the time in which we're going to find a lot of things hitting the fan, really. That's why people speak of the recession now, because we're seeing growth slow from companies that report. We're also seeing growth slow overseas. You have inflation running higher than it has in the previous quarters. We're also seeing credit dry up. The Fed is tightening, which means that the rates are going up. That's why the Federal Reserve has been increasing their rates. You're seeing companies coming out with profit declines, negative guidance. This is all part of the recession. This is part of that fourth interval. The third interval is late, so it's called the late cycle. That comes before the recession, but remember, it's a clock. It never stops moving. There are times in which it can go backwards, the business cycle. Like it can go from mid to late. It can go from late to mid, or it can go from like mid all the way to a recession. Which is why there's so much talk of recession. Technically, a recession is two negative quarters of GDP, even though the very last quarter that they recorded of GDP was only like slightly negative. It wasn't like deeply negative, unlike 2008. The other parts of, or the other intervals of the business cycle are mid. So mid is going to be the period where things are peaking. It's not the top of the mountain, but a lot of things are coming to crest, if you know what I mean. A lot of things are going up, like company reports, like inventories, sales are going up. Companies are reporting better, and also new concepts are working really well. So that's the mid cycle. The early cycle is the beginning. So again, I'm going to post the picture here, but the early cycle is going to be just like a clock that's recurring. The early cycle is going to be right after the recession because, as I mentioned earlier, it never stops moving. It's constant for where we are in the economy, just like the economy never stops moving. So the early cycle, that's when you'll notice things are bouncing off from the recession. We're no longer at the lows in the economy. Credit is beginning to grow. You'll also notice that the Fed may stop easing if they have been easing or cutting the rates Profits are growing pretty nicely, if not pretty rapidly. New starts are happening, housing starts are happening, things that were off track related to the 11 sectors are now coming back on. Like if industrials or like train and rail were off, those will start doing better. If gold has been slumping, that'll start doing slightly better. The previous early cycle, Bitcoin took off. So that was also a new creation or relatively new creation start. And then the mid cycle is when a lot of those new Bitcoin ETFs were released to the market. So it just puts it a little bit more in perspective. Why am I telling you this? Well, that is a very, very fine question. I'm telling you this because this impacts your money. That is why I'm telling you this. There are times in which if you don't know what cycle we're in and you decide to go out and invest in something, that you could be too early or too late. Like right now, the U.S. is somewhere between the mid and the late cycle, which is not really necessarily the time when tech is doing so well. In fact, I'm going to pull up a sector-based chart here. I'll also try to put this on the screen for you right after this because I care. So like we're right now in like the mid to late cycle. The Dow is continuously experiencing lows each day. We're not at the pure low on the year, but we're pretty close. And at this current time, year to date, consumer discretionary is down 25%. So if you were a person who had a lot of companies in your portfolio, like Target, Walmart, Home Depot, who else is a big retailer? Maybe Gap. I'm stretching here, but it's the stores that we go in to purchase things. Macy's would be another one that we don't necessarily have to have, but they're just discretionary leisure items. That's down 25% on the year. Real estate is down 16.99%. Materials is down 5.18, and materials is going to be gold. It also is going to be wood and other textiles for building. Financials year to date are down 11.69%. This is as of today's date. And energy is up 20.68%. So if you were a person who wanted to build a portfolio that was diversified, you would be taking a blend of all those averages, and that would be essentially what's in your portfolio. So it's kind of hard right now at a time when you want securities to go up for you to make money in the market. But if you did have a security that was more so conservative or blended, moderate, or even if you added a higher portion of cash to your portfolio, you may actually find that it has a better performance. I'll also try to put a chart up that will cover a little bit more of that. So why does this matter to you? This matters because I talk a lot about the principles related to investing as well as trading, because to me, that's where you're going to get your bread and butter. That's where you're going to pick up the best habits that are going to carry you the longest. It's not in my behavior to just give certain stocks for you to go out and purchase, because then we have to look at when should you buy it, when should you sell it. And that is a different level of expertise than what is in these videos. It can be done most certainly, but if you're looking more so about understanding how things work as well as good financial health, it's just like Warren Buffett says, buy companies that you know, buy companies that you trust, buy companies that have very strong fundamentals. Technicals do help, sure, especially being a numbers person, but technicals don't always win you the day. Fundamentals definitely don't always win you the day, but it does help. It does help. A good portfolio that has a fair amount of companies that are strong in it is going to perform a lot better than you choosing the hot stocks that showed up on whatever list out there in the world. No shade, no shade. So I wanted to cover the business cycle. I know that's a lot. I know it is a lot, but it does impact your trading. The other part that impacts your trading is allocation, but that's going to be another longer video. Let me know If you have questions, don't be ashamed. Get at your financial chef and your coach, which is myself, Khyla P. Barnes, and let's talk money. That's what I do. I'll talk to you soon.